Welcome to Her Money Revolution. I'm your host, Angela Brooks, your guide on this journey to becoming a wealthy woman. As a certified financial planner, owner, and advisor at Family Capital Management, I'm on a mission to simplify the conversation around investing and to help women generate more wealth by making their money work for them. Join me as we navigate powerful financial planning strategies to help you achieve your personal and professional goals. This podcast is your go-to destination for no fluff, easy to implement financial and investing advice. If you are ready to achieve audacious financial goals, dream beyond boundaries, and generate massive wealth for you and your family, this podcast is for you. Grab a notebook. Let's get started. Hello, and welcome to Her Money Revolution, the podcast where we empower women to grow their wealth by making their money work for them. I'm your host, Angela Brooks, and today we're talking about something that might sound like a math lesson, because it is, but trust me, it's so much more. It is the secret sauce to building wealth over time. Anybody know what it is? Compound interest. If you've ever wondered how to make your money work for you, this episode, I promise, is for you, because by the end of today, you're going to understand why Albert Einstein himself called compound interest the eighth wonder of the world. And you'll learn how you can harness it to transform your very own financial future. So grab a notebook, grab a cup of coffee, take a deep breath, and let's dive in. All right, let's start with the basics. What is compound interest? Simply put, compound interest is the interest that you earn not just on your original investment, which is the principal, but also on the interest that accumulates over time. It's like a snowball rolling downhill. It grows bigger and faster the longer it's in motion. Once it gets that momentum, it just keeps growing and growing and growing. So the simple actual formula, the math problem, right, is compound interest equals principal times 1 plus rate raised to the power of time. So what does that mean? All right, well, principal is the initial amount of money that you invested. And then you're going to add 1 to the rate, which is the annual interest rate expressed as a decimal. So that 5% becomes 0.05, for example. Raise this sum, the 1 plus the rate, to the power of time, and which is the number of years that you're going to keep your money invested. And then you multiply the result by the principal to calculate the total amount, including the interest earned. So hopefully, did you capture all of that? I know it's a lot. So if not, I know who wants to do math right now anyway. So let me make it more a visual picture for you. So imagine you plant a tree. This is your principal. Over time, it grows apples. That's your interest. And then those apples fall to the ground and then grow more trees, which produces more apples. And before you know it, you have an entire orchard. That, my friends, is compound interest in action. So here's the kicker, though, with compound interest. The longer you give it to work, the more powerful it becomes. This is when time truly does become your best friend. You want to start as early as possible, and you want to stay as consistent as you can, because compound interest, well, it loves to party, but it takes a while to get going. So I'm going to give you an illustration in numbers, right? So imagine that you have $10,000. You're 25 years old, and you invest that, and you're earning an 8% annual return. By the time you're 65, without adding another penny to your original investment, that $10,000, but by the time you're 65, your investment would grow to over $217,000. Now, let's say that you wait until you're 35 years old. So you wait 10 years. You use that same $10,000 and you use the same 8% annual return. But now, by the time you're age 65, you would only have just shy of $100,000. That's a big difference. And the big difference is time, right? This is an illustration of why starting as early as possible is so very important. But don't worry, listen, if you're starting later, if you're in your 40s or your 50s and you're like, man, oh man, it's too late. It's not. Compound interest will still work its wonders. The key is to start now. Even if it's small, just start a small investment now. So another thing I want to clarify real quick is I just used in that illustration the 8% growth rate as an example. 8% annual return is considered a reasonable estimate for long-term growth-focused investments in the stock market. But when I meet with my clients and I create a long-term plan, I truly like to show something a little bit more conservative. So I use a 5 to 6% growth rate to forecast out between now and their age 100. It's just somewhat more conservative approach. It's important, though, to put it into perspective because historically, the S&P 500, which serves as a benchmark for U.S. stocks, has delivered an average annual return of about 10%, which is before inflation. And that's, the past century. So when we adjust that for inflation, the number actually sits closer to around 6 to 8%. So that's kind of why I like to show a 5 to 6. It's still somewhat conservative. But an 8 to 10% return assumes that you're investing in a very well-diversified portfolio of stock-heavy mutual funds and ETFs while also reinvesting any dividends. So you're not taking money out, growth investment philosophy, and you're reinvesting those dividends. So this approach has historically been a real reliable way to grow wealth over a longer term. Okay, now listen, if you're still thinking, Angela, I totally missed the boat. I'm just going to stop listening now because I'm 50 and I haven't done anything. Don't. Listen, take a deep breath and relax. Again, it's never too late to start investing. Compound interest does not discriminate. It doesn't care when you begin. It's ready to work its magic whenever you are. So I want to encourage you, just start. Okay, another quick little party trick that I like to use once in a while. It's called, and you might have heard me mention this before, but the rule of 72. This is a pretty handy rule. It helps you figure out how long it'll take for your money to double. Okay, so you just divide 72 by your annual rate of return. So for example, okay, if you're earning 8% annually, it's going to take you 9 years for your money to double. So it's 72 divided by 8 equals 9. Get it? If we're using a 6% annual return, it's going to take you 12 years for your money to double. 72 divided by 6 equals 12. So the rule of 72 is surprisingly, for moderate interest rates, typically between 5 to 12, it's pretty accurate, but it's not a perfect calculation. It doesn't actually compound. You're using compounding. It may vary slightly depending on how frequently the interest is applied. So for example, if you're invested in an investment and interest is applied on an annual basis, that's going to be different than if it's applied on a monthly basis. Also, if you're making biweekly contributions, for example. So it's not a perfect example or it's not a perfect tool, but it provides a really reliable ballpark to give you a quick estimate. I think the rule of 72 is a pretty cool trick. It's a powerful reminder of the benefit of compounding, and it's useful because it illustrates how small increases in your annual return will significantly reduce the time it takes for your money to grow. So if you ever hear that concept, the rule of 72, well, now you know it's a quick little party trick for you. Now, unfortunately, there is a dark side to compound interest. It's just give you a quick reality check. It is amazing. Compound interest is amazing. It's basically magic. I do believe that. But there are 4 things that can really mess it up. Number 1, pulling money out too soon. Imagine taking the popcorn out of the microwave before it's fully popped, right? You're missing out on all of the good stuff. You want to leave your investments alone as long as you can, and you want to let them grow. Number 2 is high fees. It's important to be mindful of fees on your investment accounts. A 2% fee may not feel like much, but over time, it will cost you possibly tens of thousands of dollars. So be aware of the fees that you are paying because they will eat away at your returns. They slow down, obviously, the compounding process. So when you're working with a wealth advisor like myself, make sure you understand how they are compensated and the fees that they are paying. We look for low-cost investment options like index funds or ETFs or funds that are not going to cost you much to minimize the effects that it does on compound interest. And number 3 is inflation. Don't forget about inflation. It is the silent factor that reduces your purchasing power over time. The beauty of compound interest is that it helps you stay ahead of inflation as long as your returns are outpacing the rate of inflation. And the 4th one, this one is the most, well, I won't say the most important, but it's really important. It's the impact of negative returns. So many asset classes experience down years, right? We understand the stock market goes up and it goes down. Those down years amplify the negative impact of losses over time. So negative returns don't just hurt your portfolio in that moment, they can also diminish the power of compounding over time. So remember, compounding, it is a powerful tool for growing wealth, but when losses occur, it also amplifies the challenge of bouncing back. So I want to spend a little bit more time on this point, and I want to talk about what this means, and more importantly, how we can overcome the negative impact of negative returns. So the challenge of negative returns is, imagine you invest $1,000, and in the first year, your portfolio grows by 20%. That's great, right? That's $1,200. But in the second year, you lose 20%. Where does that leave you? Not back at $1,000, as you might be thinking. Negative 20% down, you're actually left with just $960. So now picture this up and down cycle continuing. And for illustrations, let's say 20 years, which the reality of it going up 20, down 20 consistently for 20 years is not likely. But for my illustration, this is what I'm showing here. Instead of growing your wealth over that 20 years, you would just end up with $664.83, right? That is a far cry from financial security that you envisioned. So I'm just illustrating the dark side of compounding. Losses create a significant gap that requires increasingly higher returns to recover. Okay, so this example, like I said, is a bit extreme, up 20, down 20, but it highlights an important point, and that is having the right investment advisor to manage your wealth is critical. You want to work with an advisor that understands the stock market, that understands when to do a rebalance, when to get out of certain funds. It is truly critical. Here's the good news. You don't have to let negative returns control your financial future. You want to have a disciplined approach. You want to use smart strategies, and you can harness the power of compounding while also mitigating its risks. And you can work with a wealth advisor that understands all of this and helps guide you in the right direction. Okay, I want to turn it around a little bit. We give you 5 tips to overcoming the dark side of compounding. So tip number 1 is to invest with the trend. Markets move in cycles, right? The bull market and the bear market. A bull is a rising market. A bear is a falling market. So understanding these trends will help you position your investments wisely. When you are on the right side of the trend, compounding obviously is going to work for you, both in up markets as well as in down markets. So the first step is to determine whether the market is in a secular bull or bear trend. And when I say secular, that means a long term or multi-year is what that term means. So you want to understand, is the market going to be in a bull trend or a bear trend? And then you want to invest with that trend. So sounds pretty easy, right? Well, during a bull market, it's relatively easy to do well and to ride the wave of growth. 2020, for example, the last couple of years, actually, we've been in a pretty good bull market. A lot of portfolios are growing. If you're not, you should be asking your advisor why it's not growing, but it's relatively easy. The common quip is correct, right? A rising tide floats all boats. Have you heard that term before? But in a bear market or even a flat market, different stocks and different sectors are going to perform well at different times. Hopefully you captured all of that. So when you're in a bear market in these environments, winning investors seek stocks that offer the best absolute returns. And that means the return that an asset achieves over a specific period. So an absolute return measures This measure looks at the appreciation or the depreciation expressed as a percentage, for example, that an asset, such as a stock or a mutual fund, is going to have over a given period. Okay, so absolute return differs from relative return because it's concerned with the return of a particular asset. And it doesn't compare to any other measure or any other benchmark out there. Okay, so I look at the best absolute return in strong sectors. And a sector is an area of the economy in which the businesses share the same or related business activity or product or service. That's considered a sector, like technology sector, for example. So basically, investors must become good stock pickers rather than just investing in a diversified portfolio of stocks, which this is going to bring me to tip number 2 to avoiding the dark side of compound interest. And that is you want to diversify beyond just stocks. I'm going to get technical with you, but the key here, I want you to understand or hear some of these terms. So then when you are talking with your advisor, you can ask them about these. Okay. So using the value approach to investing can have excellent results. It can also be useful to learn how to short the market when the trend is down. Another strategy is to use bonds. You want to build a ladder that provides relatively safe return. It acts as a buffer against the stock market volatility. Another great strategy would be exploring other income generating assets. Well, assets that are going to help stabilize your portfolio during weak markets. Diversification obviously is key, but there's different income generating assets that may have downside buffers or protections on them. So you want to explore some of those strategies. Number 3 to avoiding the dark side of compound interest is to use the proven risk management techniques. One of the most effective ways to protect your portfolio is by actively managing risk. So that doesn't mean calling your advisor, oh, the market's down, get me out. That's not what I'm talking about. I'm talking about being mindful. And during weak markets, when negative compounding can be substantially harmful for your portfolio, it's even more important to use these proven capital management techniques, okay? So some of them would include trailing stops. So for example, setting up a stop loss order. This is going to minimize losses, or it's going to lock in profits when an investment starts to decline. Another proven risk management technique is the frequent rebalancing. So working with us, we do systematically 2 rebalances a year. You want to make sure that you are utilizing a rebalancing technique on a regular basis, which is adjusting your portfolio to take advantage of the short-term market cycles. Okay, so what you do is you sell high-performing assets, you free up capital to reinvest it in undervalued opportunities. Again, working with an investment advisor that understands these concepts is really beneficial for you. Number 4, to avoiding the downside or the dark side of compounding. Number 4 is capture profits along the way. Okay, so you could do this in part of the rebalancing as well, but you don't want to wait for that perfect moment to take gains. If an investment grows quickly, you really want to look at it and consider selling part of the position or all of the position to lock in profits while moving your stop loss order higher to protect the rest if you only sell a portion of it. This approach obviously is going to ensure that you capitalize on gains without overexposing yourself to unnecessary risk. So understanding when that perfect moment is. Number 5, you want to stay disciplined and you want to stay proactive. The biggest mistake investors make is being a passive investor, being passive in the face of market challenges. Successful investors are active managers of their portfolios. They understand market trends, we identify opportunities, and we consistently use strategies to protect and grow our wealth. Okay, so I'm not talking about chasing after returns and finding the next shiny thing. I'm saying stay consistent to whatever that investment philosophy is and be mindful of identifying other opportunities. So I know if this feels overwhelming, hire an advisor, work with a financial advisor that you really, really can trust. The bottom line that I want to emphasize to overcoming the dark side of compounding interest, it's going to require that an investor be an active manager of his or her portfolio. because negative returns and compounding losses can be devastating. You may have even experienced it yourself, but with the right mindset and with the right techniques and with the right advice, you can overcome a lot of these challenges and position yourself for long-term success. Again, this is going to require learning the skills needed to recognize market trends. You want to find appropriate investment opportunities, and then you want to employ proven capital management techniques. Overcoming the negative side of compounding interest and beating the market can be very satisfying if it's done right. Okay. After all, this is about way more than numbers. It's about way more than beating the market. It's about your money. It's about your goals and your future. So you want to make it count. So how do we do that? Let me give you a few action steps that can actually help you harness the power of compound interest, the bright side of compound interest. So here's 4 action steps that you can take. Number 1, start investing ASAP, as soon as possible. Don't wait for that perfect time or the perfect amount of money. That perfect moment does not exist. You want to start now, even if it's small. Like I said, the sooner you start, the longer your money has to grow. Number 2, you want to invest consistently. Make regular contributions to your investments, whether it's through your 401k with your employer or traditional IRA, maybe a Roth IRA or a brokerage account. When you automate your savings, that also makes it easier to stay consistent. It's out of sight, out of mind, but growing all the time, right? So go open an investment account if you don't already have one. Yesterday would have been better, but today works too. Number 3, reinvest your returns. If you're earning dividends or if you're earning interest on some of your investments, reinvest them instead of cashing them out. This keeps that compounding process in motion and it builds that momentum like a snowball. I have some clients that are like, oh no, I want to take out my dividends. I want to cash in my interest. That is negative effect for compounding interest. It doesn't work as well. So keep those invested. Number 4, educate yourself. Learn about low-cost index funds or low-cost ETFs. They're great for long-term growth with lower fees. Continue listening to Her Money Revolution to learn about these key concepts and terms. And even if you can't grasp all of them, I know you're probably driving in your car, maybe putting your makeup on or whatever you're doing. It's probably hard to grasp everything that I'm saying. But the key is to hear the concepts and then you can research it further, or hear the concepts and then you can ask your advisor, hey, am I invested in low fee index funds? So ladies, it's important. And here's why. For me, I want this to matter for us so much because we are going to live longer, right? Statistics show that we live longer, which means that we need more money to fund our retirement years. So when we make compound interest our ally, this is going to be helpful for us in the longer years that we have to live. Start now, stay consistent. You can build wealth that supports you for decades. And remember, it's never too late. Whether you're 25 or you're 55 or somewhere in between, compound interest will help you take control of your financial future. So there you have it, the magic of compound interest and how it can work for you. Whether you're just starting out or already well on your way in your financial journey, these principles that we talked about today will make a huge difference in building wealth over time. Remember, the key is to start as soon as you can. The key is to stay consistent and let time do its magic. Think of it as like your quiet little financial sidekick working tirelessly in the background. It thrives on consistency. It thrives on patience and discipline. And the earlier you begin, the more rewarding your results are going to be. Thank you so much for tuning in to Her Money Revolution. If this episode resonated with you, share it with a friend who needs a little nudge to start their own financial journey. Remember, it's not about having it all figured out. It's about taking one baby step at a time. Until next time, keep making those money moves and let your dollars hustle for you. Thank you for joining me today, and I hope you are feeling more empowered in your financial journey. Remember, Follow and subscribe to Her Money Revolution on your favorite podcast platform and share your feedback by leaving a review. I'd love to hear your biggest takeaway from today's episode. Until next time, stay inspired.